Yeah. Hello. Yes. So am I audible now? Fine, right? Okay. Yeah, guys. So this is the second part of the startup jargon Buster webinar series. So in the first part, we actually discussed about the basics of what like the fundraising process, or gave an overview of the fundraising process. Also, we spoke about like what all topics we would be covering in this webinar series and things like that. So now this is so the last session was more of a kind of an overview. Now from this session onwards, we are actually starting to break down the things and concepts. So I thought first of all we'll put a kind of very interesting topic, how to value your startups. So yeah, so that is the topic that we are covering for this week. So valuation of a startup is actually a very basic query that I get a lot from many early stage founders because they don't know like what value to put to your startup. And I'm not sure how many of you attended the last session when I told you about not obtaining a valuation. Like people tell that valuation report is a mandatory thing for fundraising. I mean a prerequisite for fundraising, but I'm totally against it because no investor would be asking for a valuation report in an early stage fundraising deal. So in that scenario, like what is the value that you should be arriving? So that is a very, very, very kind of main question what I hear from a lot of founders. So today we'll actually try to break things down and understand like how to value a startup, and when pitching to an investor, what is the value that you should be proposing to an investor. So telling all this is not going to be a very technical session or anything. It's based out of thumb rule that we'll be designing, and definitely let me be very honest with you. Value for your company is the value that you put for your company, and that is your gut feeling. But definitely there should be another person and another investor or a buyer who is actually willing to buy or invest in your company at that value. Then only that value has a relevance. For example, you have a kind of 10 cents of land in Cochin, and the market rate is say maybe 10 lakhs person, but you are planning to sell it for 1 crore person, and you are telling like 10 into 1 crore, 10 crore is the value of the land. Like no buyer would be interested in buying that land at a very higher value. So when you put some value, understand that there should be a person acknowledging that value, an investor should acknowledge that value and put money in your startup based on that value. Then only your value is justified. So it's purely based on your gut feeling only, but like somebody has to acknowledge it. So it's a tricky thing, but we'll try to kind of understand it. So what is the value of a company and types of? So we'll actually go a bit into the basics of valuation, understand like what pre-money valuation is, what cost, because these terminologies are very, very important in a fundraising deal and while telling valuation for a company. So basically there are two types of value for a company. One is the pre-money value and the other one is the post-money value. So when I say pre-money value is nothing but the value of a company at this point. So now, if you are going to sell this company, how much it would fetch? That is the value of that is the pre-money value of a company. So and I'll tell post-money valuation. Then only you will be able to understand what pre-money is. Then post-money valuation is value of a company after the investment. So there is a formula to compute post-money valuation. It is nothing but pre-money valuation plus investment amount. So now let us go back again to this pre-money, post-money value definition thing. So suppose you are actually valuing your company at 10 crore now, and you're planning to get a fundraise of maybe 2 crore. So it's 10 plus 2. 10 crore plus 2 crore is the post-money value. So 10 crore was the pre-money value. So before investment, what your company values is the pre-money valuation. Or ideally speaking, see, generally we will be using post-money as a valuation term in most of the fundraising deal. But it should be kind of very evident and very clear that which term we are using because a lot of things depend on whether it is pre-money or post-money. So I know it's kind of a bit confusing. So, but try to understand that pre-money valuation is nothing but the value of your company at this point of time. So before an investment coming in, this is the value of the company. And post-money valuation is the value of the company after the investment. So post-money valuation, the formula is pre-money valuation plus investment amount. So you have a company with a pre-money valuation of 10 crore. You're raising 2 crore of fund. Then your post money valuation is 10 crore pre-money valuation plus 2 crore of investment. So it is 12 crore. And the percentage of dilution, okay, the percentage of dilution. So the percentage would be computed after the investment. So investor has put in 2 crore money and now the value of the company is 12 crore. Okay. So when the investor doesn't put in any money, he doesn't own any stake and the value of the company remains 10 crore. When an investor put in 2 crore, then the value of the company changes to 12 crore. And what the investor would be getting would be investment amount divided by post money valuation, the percentage of dilution. So in this case, it is going to be 2 crore divided by 12 crore. It is going to be somewhere close to maybe 16.67% or something. That would be the percentage of dilution. Is this point clear to everyone? You can type in the chat box if it is clear. Okay, do I need to explain it once more? If anyone need this topic to be explained? Okay. Yeah, hi, Srijan. Will explain once more. Yeah, okay. So basically, there are two types of valuation, two types of value for a company. One is the pre-money value, and the other one is the post-money value. So pre-money value is nothing but the value of the company at this point of time. So you are going for a fundraise. Then before the fundraise, what is the value of your company is the pre-money value. Post-money valuation is the value of the company after the investment. So it's nothing but pre-money valuation plus investment amount. So let us go to the example once more. See, now, maybe the thing what confuses you might be kind of this where did we arrive at this 10 crore and all that we'll discuss later. But at this point of time, just try to understand the concept. So pre-money valuation is the value of the company before the investment at this point of time. So you have a company and you are valuing it at 10 crore and you are raising 2 crore of fund. Then 10 crore is the pre-money valuation, 2 crore is the investment amount. Post-money valuation is nothing but pre-money valuation plus investment amount, which is 2 crore plus 10 crore equal to 12 crore. Okay. And percentage of dilution. Now, when we are considering the percentage of dilution, at the 10 crore stage, the pre-money stage, no investor is there actually. Okay, so there is no dilution happening in that point of time. Dilution happens only when the investor puts in money. And dilution we will be considering the post-money valuation because that is the valuation of the company after the investor has put in money. So the percentage of dilution is going to be 2 crore divided by 12 crore, which is going to be 16.67%. Now I think it is clear. Okay, so can I go to the next slide? Yeah, okay, Shijin. Thank you. I'll go to the next slide. Okay, so why pre-money and post-money valuation is important? This is the point what I was telling you earlier. So suppose, see, we are actually kind of silent about, we are kind of silent on what is the, I mean, whether we are telling pre-money or post-money in an investment deal. For example, a company A is raising 5 crore at a valuation of rupees 15 crore. We are not telling it is pre-money valuation. We are not telling it is post-money valuation. It's just the thing. And you are suppose kind of negotiating a term with the investor, stating that 5 crore at valuation of 15 crore. Now, you were actually pitching pre-money valuation to the investor, 15 crore. But the investor was thinking 15 crore is the post-money valuation. Okay. So now let us look at the scenario one. What is your point of view? What is your POV? Okay. The valuation of rupees 15 crore is the pre-money valuation as per your understanding, as per what you have pitched with the investor. Okay, clear? So the investment amount is 5 crore. Fine. So what is the post-money valuation going to be? It is pre-money valuation plus investment amount. If you remember the formula in the previous slide. See, pre-money valuation plus investment amount is the post-money valuation. So it is going to be 15 crore plus 5 crore equal to 20 crore. And what is the percentage of dilution? It is going to be post investment amount divided by post money valuation. See the formula. So here in this case, what you were assuming was that the investor would be putting in 5 crore at a pre-money valuation of 15 crore, which will make your company's post-money valuation to be 20 crore. And the percentage that you are diluting to the investor would be 5 crore divided by 20 crore. Sorry, there is a typo error. It's not 20%, it's 25%. I'm really sorry about that. So it's going to be 25%. Okay. Is that clear in scenario one? Please type out if it is clear. Okay. So I'm going to scenario two now. Okay. So in scenario two, the investor actually expected the 15 crore valuation to be the post-money valuation. But you were pitching for a pre-money valuation, but the investor thought, okay, this is going to be the post-money valuation. And the investment amount is again rupees 5 crore. Do you remember the formula for percentage of dilution? It is nothing but investment amount divided by post-money valuation. So it is going to be 5 crore divided by 15 crore. It is going to be 33.33%. Okay. So in this case, for the investor, the pre-money valuation would be post-money valuation minus investment amount, which is 15 crore minus 5 crore, being 10 crore. Understand? So that is nothing but like kind of A plus B equal to C, then A is equal to C minus B. That is the formula what we have used. Post-money valuation is equal to pre-money valuation plus investment amount. Investment amount is equal to post-money valuation minus pre-money valuation. Pre-money valuation is equal to post-money valuation minus investment amount. So now considering the scenario 2, 15 crore is the post-money valuation what the investor thought. He is putting in 5 crore money. Percentage of dilution is nothing but investment amount divided by post-money valuation. So it is going to be 5 crore divided by 15 crore. It is 33.33%. So now you see the difference. Like 8.33% is the difference in dilution. What has happened? Like just because we haven't mentioned pre-money or post-money in the deal, the confusion might have cost you kind of 8.33% of the company. So now I think the concept of pre-money and post-money is clear to you, and why pre-money and post-money valuation is important. So I'll just take you through the example once more. Okay, does anybody have any doubt? Like if you have any doubt, you can actually put it in the chat box. You can raise your hand or put in the chat box if you have any doubt or anything. But I'll be just explaining the scenario, both scenarios once again. Please make use of the chat box. Like I've kind of muted everyone. Can I proceed to the next one, or I'll just explain it once more? Okay. Yeah, thank you, Girish. Yeah. So, but I'll just why pre-money and post-money valuation is important. Like suppose a company A is raising 5 crore at a valuation of rupees 15 crore. Scenario one is where the company founder thought that he was pitching for a 15 crore pre-money valuation. Scenario two is where the investor thought that the pitch was for 15 crore post-money valuation. So in scenario one, what the founder thought is like kind of the pre-money valuation is 15 crore. He's going to raise 5 crore rupee. So the post-money valuation is going to be pre-money valuation plus investment amount, which is going to be 15 crore plus 5 crore equal to 20 crore. And the percentage of dilution is 5 crore divided by 20 crore. It is 25%. The text there is wrong. I'm absolutely sorry for that, but it is 25%. Now coming to scenario two, wherein the investor thought is like 15 crore is for post-money valuation. So the investment amount is 5 crore. So what the investor was thinking was like kind of, okay, he's going to get 33.33%, which is 5 crore divided by 15 crore of the company. But actually the investor is going to get only 25% of the company. Okay. Is that clear now? I'm proceeding to the next slide. Okay. So this is actually going to be a very, very short kind of session today. Because I just want to kind of give you all an overall idea on how valuation and what are the important concepts involved in valuation. So I'm moving to the next slide. So how to value an early stage company. So that is the topic what we are actually kind of addressing today. I mean, in this session. So for example, many early stage founders actually find it very difficult to pitch to the investor the value of the company. That is one challenge many early stage founders face, even at a pre-revenue stage or an idea stage. People are not kind of able to evaluate what value should I give to the company, what would be good, what would be wrong. So there is a kind of dilemma for every founder at that stage. See, there are technical ways to do valuation, but for pitching to an investor in an early stage deal, you won't be requiring a proper valuation report. Let me repeat this thing. There are technical ways to do the valuation, and those things are required for compliance purpose or maybe for a later stage deal. But for an early stage deal, I, as per the investors, I know, like I'm in Bangalore for the past few days, I have been attending a startup event and I have been speaking with a lot of investors. Everybody validated me and acknowledged me with the fact that they never asked for valuation report for an early stage deal. It's purely based on negotiation. Like some startups negotiate at a very higher rate, but if the idea seems very interesting to them, the investors are willing to negotiate and bring down the value and invest in the company. So that is what they look for. So unless and until you are asking for a value which is very exorbitantly high, uh, I don't think that's going to be a problem. But let me be very clear: in an early stage deal, definitely you won't be requiring a valuation report. Like there will be a lot of consultants advising you to get a valuation report. Pay 50,000, pay 30,000, pay 60,000, get a valuation report. Then you can pitch to the investors. You know, investors is going to look at the valuation report for an early stage company because all the majority of the technical ways to do valuation uh, is by a method called discounted cash flow method, wherein you will be projecting the cash flows for next 5 years or maybe whatever number of years, and then using a discounting factor, you will be arriving at a value today. I'm not going into the technicalities of that, but just imagine like it's based on projection. So how can you actually validate that with an investor? You understand, na? Like how can we actually kind of convince an investor that see, I have got a valuation report from the valuer, and it is stating that my company is having 50 crore valuation. See, only if you start doing business or you get that fund, your company will be having 50 crore valuation. So please believe me, like there will be a lot of consultants and there will be a lot of people coming to you and telling that do a valuation report first, understand the value of your company, don't go for a kind of bad deal or anything. But let me be very clear: doing a valuation report at the time of pitching is kind of a waste of money for an early stage deal. I am very much stating the early stage deal because at a later point of time, you may be required to get a valuation report before a deal or so. Like these all depends on the deal size and everything. And also one more thing, what I want to tell you is that there are actually options to defer the valuation report of a company to a later stage by using convertible instruments for an early stage deal. So, for example, if you're not very sure about the valuation, you can actually ask the investor to invest by using a convertible instrument. We'll be discussing in detail about convertible instruments in any of the coming sessions. So, somebody has put out something. See, Santosh, like definitely we can connect. Okay, like, but I would like kind of encourage you to kind of have the discussions in the group, or you can get my number from the group, and then we'll actually discuss about that. Hope that is fine. And I'll just continue. Okay, okay, Santosh. Thank you. Yeah. So there are actually so we'll speak about convertible instruments at a later point of time. But please understand that there are convertible debentures, there are convertible preference shares, there are convertible notes, wherein we won't be specifying any value for the company at this point of time. Investor would be putting in some money, and they will get it converted to equity at a later point of stage, at a later valuation. So you don't have to. So if you are not sure, and the investor is also not sure about the value of the company, say they are putting in 50 lakh. Okay, next time when you do a proper fundraise, what is the value of the company at that point of time? Give me a 20% discount. So if you are raising next funds at 10 crore valuation, this investor would be having valuation of 8 crore, which is 20% discounted value of that fundraise. So there are options like that. So why I am telling this is because valuation report is not at all a mandatory thing for an early stage company. Okay. So I hope that thing is clear to you, because I just want to kind of emphasize on that thing mainly because like there is a lot of valuation. I see a lot of value. Even I've seen a pre-revenue stage company having they are coming to me telling that they got some valuation report for 200 crore and they are raising 32 crore. See, in a practical scenario, it is actually very difficult for a pre-revenue stage company to have 200 crore valuation and then raise 32 crore from an investor. See, I don't think that is going to. I'm not telling it is impossible, It may be possible if your idea is that good and the investor gets convinced and they are also kind of excited. Then in that case, maybe I don't know, like deals can happen like that. But in 99.99% of the case, that's not going to happen. So please don't get a valuation report. Please don't spend your money on unwanted things right now. But I'll tell you a simple way like how to start a negotiation with an investor. So I don't know whether like many of you might have attended the previous session, many of you might not have attended the previous session. If you have not attended, there is a video recording of that session. Please try to see it. So I have spoken about like kind of creating a business plan or identifying the fund amount of fund that you want to actually raise from an investor. So basically, there are two types we raise funds. One is for the operational cash flows and one is for the one-time setup cost. So identify the fund that you want to raise. Maybe you are looking for a fundraise for 18 months. Create a proper business plan for 18 months, like what your revenues are going to be, what your expenses are going to be, what are your capital expenditures or asset building costs going to be. Find the kind of difference. What is the total negative you have? Sum it up. That is the fund that you want to raise from an investor. Guys, please don't worry. Like if you don't understand how to what I'm telling right now, we will be definitely having a session on creating a business plan and identifying how much funds to raise. But for the timing, just understand like it's going to be something like you're raising funds for 18 months. You'll be projecting the month-wise revenues, month-wise expenses, which all month, what all investments are you going to make for assets, and what is the negative cash flow that you're going to generate. That is the amount that you require to be funded. Okay. Then determine what percentage of the company you are willing to dilute. That is actually another tricky thing, but definitely there are few things like there are few thumb rules in an early stage, in the first stage of fundraising, don't dilute more than 15%. So it all depends on industry to industry, like how many funds you are raising, planning to raise in the future. For example, there can be a model who can actually raise one round of fundraise and then be a sustainable model. There can be a company who can actually be raising like kind of multiple fundraising attempts. So in that case, you should be a bit more stringent about your dilution because you will lose a you lose a large portion of your company at multiple fundraisers. So it won't be advisable to kind of dilute a very high percentage at the initial point. Okay, so this is something what you have to actually decide. You can take a kind of advice from your consultant or maybe some industry expert or some founder whom you know who have raised funds and decide. Okay. So here I am going to tell the post money valuation. If you remember what I told pre-money and post money, in this case, the post money valuation that you should be pitching to an investor should be proposed investment divided by the percentage of proposed dilution. So it's again A divided by B is equal to C. If it is A divided by B equal to C, then A is equal to C by B. So see here, percentage of dilution is equal to investment amount divided by post money valuation. So post money valuation is nothing but investment amount divided by percentage of diluted. So this post money valuation in the denominator goes to the numerator side of the other side, and the percentage of dilution in the numerator side comes to the denominator side. So it's investment amount divided by percentage of dilution. So see, post money valuation is equal to proposed investment divided by percentage of proposed dilution. Okay, so this is a theoretical part of that. I'll just explain this with an example. Hope the other parts are clear. Like I'm moving to the example right now. Okay, suppose company A has created a business plan and has arrived at the following inferences. Expected operational cash flow deficit is rupees 1.5 crore. Expected one-time setup cost is 1 crore. So when I say one-time setup cost, it shouldn't happen in the first month itself. Maybe you are planning for hiring 6 more people in the 8th month. At that point of time, you may be requiring some laptop. So one-time setup cost doesn't mean that it should be the first. It should be incurred in the first month itself. It can be incurred at a later point of time also. But one-time setup costs are basically asset building costs. And operational cash flow deficit is kind of your for the 5 months you are not raising any revenue, but you want to pay salary, you want to do marketing, you want to pay rent. That is your operational cash flow deficit. And after the fifth month also, you will be generating a very low revenue, not compared when compared to the expenses. So that is the operational cash flow deficit. And one-time setup cost is the asset building cost. So in this case, the total fundraising requirement for company A is 2.5 crore, which is 1.5 crore plus 1 crore. Hope that is clear. So it is 1.5 plus 1 crore. Now, company A is actually willing to dilute 10% of the company to the investor at this point. I mean, at this fundraising. Okay. Is that clear? So that is something the company A has to take. Okay. Now, the proposed company value that A should pitch to the investor would be proposed investment amount divided by percentage of dilution. So that is going to be 2.5 crore divided by 10%, which is going to be 25 crore. See, if this 2.5 crore divided by 10% calculation is kind of difficult for you, just use a calculator at that point of time, or use an Excel. Like, you don't have to do it manually. So 25 crore should be the value that the early stage company should be pitching to the investor. See, having said this, this is not a technical formula. This is not a proven formula or anything, but this is something what you can actually pitch to the investor. Definitely, the investor can have a difference of opinion, and all those things happens like that. So, if it is 25 crore you are pitching, definitely see. The thing is that investor can tell that, see, I don't see more than 10 crore. Then you can negotiate and maybe you can reach at a figure of say 15 crore or 18 crore. That can happen. So that negotiations can happen. But when pitching to an investor, just be kind of try to be realistic to yourself. Try to understand like kind of how many fundraise you would be requiring. Like, is it going to be a lot of fundraising, a lot of fund requiring model? If that is the case, like I told, you can't dilute more than 10 to 15% in the first round of fundraising. That is a general thumb rule. Again, nothing proven or anything. That is what usually companies with multiple fundraisers do. But if you are actually kind of planning to build something which is sustainable, going to be sustainable with the first fundraise, maybe you can dilute a bit more percentage at the initial point of time. That doesn't affect the things in much this one manner. Okay. So, is this example clear to everyone? Can you use the chat box? Yes. So this is basically what I wanted to speak to you about, how to value an early stage company. So when we're speaking about valuing, there are actually multiple factors that affects the valuation of a company. Uh, for example, uh, see, when approaching an investor, so I was having a discussion with one of the founder recently. So what he was telling me was like kind of when raising investment, it's like kind of it's a never ending process, or it should not be like kind of you target one particular investment and then pitch for him. So when you kind of like kind of reach out to many investors at the same time, definitely you will be having multiple investors giving you an offer. If your idea is really good, there will be multiple investors giving you an offer. So in that case, you can choose between investors. So in that case, you will not have to compromise a lot on value. So in that, when there is a competition between the investors to invest in the company, you can actually pitch for a higher valuation. See, that is what I'm telling. Like, there are many factors that affects the valuation of a company. So it's actually a very complex topic, but uh, like being in the right space and being able to kind of understand that it's not kind of much of a technical thing. For land, we will be having reference values. That's why it's easy to value a land. Similarly, for companies, like there would be reference values, but reference companies and all, but it all depends on the investor should be agreeing to your price. So if in this case, suppose in this example, if A is only willing to dilute 1% of the company. So in that case, the valuation of the company is going to be 250 crore, which an investor may not agree. See, you are telling 250 crore, but the investor says, I don't see 250 crore, so I won't invest. See, at that exorbitantly high or unjustifying valuation, then that deal may not go forward. But if you're pitching something justifiable, see, suppose in this case, 25 crore may be on a higher side, but it is kind of 20-30 percentage what the investor expected, more than what the investor expected. In that case, the deal wouldn't be called off. There will be a negotiation. And trust me, like kind of no investor would be kind of pulling off from a deal just stating that the value is very high, unless and until you're pitching something exorbitantly high or something which is not digestible to the investor. if your idea is good and the investor find you as a good founder with good conviction and who has the capability to pull off this thing, then definitely they'll be open for a negotiation. Okay. So yeah, so that is all about how to value an early stage company. Maybe in the next session also we'll actually kind of discuss about how to go for a kind of create a business plan. Yeah, so that's it actually from my end. So now we can have the question and answer session. If anybody is having any question, you can put in the chat box. I'll unmute you. So I would encourage you to ask questions because that would be helpful for others also. See, recorded version will be putting in the group, Shijan. Don't worry about that. So that is Himanshu what we were telling right now. Should I unmute you? I would. Yeah. So Himanshu, I have unmuted you. Yeah.
Am I audible?
Yeah. Yes.
Okay, so I was asking, like, I'm a founder of a company, right? But it's pre-revenue, and I want to understand how do I reach at a valuation.
See, that is what we were speaking about in the whole session. Like, I don't know whether you have missed out anything. So, basically, see, shouldn't be doing a technical valuation is what I would suggest, because no investor would be relying on a technical valuation report uh, at a very early stage. So it's better like kind of you create a business plan, identify how much fund you want to raise, and kind of understand like what percentage you can dilute at this point of time, and just divide the investment amount divided by the percentage of dilution that you're proposing. That is the value of the company that you should be pitching to the investor. But definitely seek validation from industry expert, seek validation from founders who have raised funds, seek validation from investors if you know anyone. So and then only kind of go for a fundraise because your value should not be exorbitantly high. Okay, Himanshu. Yeah, hi Shankar sir. I'm unmuting you.
Hi, Abhijith.
Yeah, hi
Very
sir.
good
Hi,
evening.
sir. Good evening,
Sorry,
sir.
I
Yeah.
joined late. I'm not at home.
Okay.
But since your session is happening and I wanted to get, listen to, but I could not because I just took a break and on the way back home.
Okay.
So I thought I'll just ask one quick question.
Okay, sir. Tell me.
So maybe you already covered in the session. So Abhijith, my question is, it's a recently started a startup. I did spend some time with the founder, etc. See, so they are looking at a valuation based on future revenue and future margin, and so made an investment of close to around 45 lakh only. So, can you suggest what could be a very crude way of arriving a best possible valuation for that for a less than 10% stake dilution?
So, sir, if they are looking for less than 10% stake dilution, then definitely the minimum valuation that they would be pitching should be 45 lakh divided by 10%, which is 4.5 crore.
Okay.
So, I think they should start negotiating at maybe 6 or 7 crore. See, I don't think no investor would be looking at future revenues and discounted cash flow for a pre-revenue stage startup because the cash flow is not stable. Like they don't know how this cash flow is going to be. We should be having some parameter to kind of understand how the cash flow of the company is going to be. So I wouldn't recommend like at any for an early stage startup. I personally won't recommend to have a valuation report. I see it as kind of an option where consultants or valued people who does valuation report make the money. I don't think there is anything kind of an investor would be looking for in that. So yeah, my recommendation would be to kind of the minimum value that they should be pitching is 4.5 crore. That is the if they don't want to dilute more than 10% for 45 lakh.
I think what the investor is looking somewhere, because it is coming closer to what you are suggesting. Without a formula, he has done something. I had two questions. When you are saying dividing by 10, is it the cost of funding you are
No, sir.
10?
That is a percentage of dilution. That's just the percentage. So, see, when an investor puts in 45 lakhs in your company and your valuation is 4.5 crore, it is 45 lakh divided by 4.5 crore, 10%. So, I actually reverse calculated it. It is 45 lakh investment amount.
Okay, I understood. So, if it is 5%, it will be same formula then?
No, yeah, 4.5 lakh divided by 45 lakh divided by 5%. It's going to be 9 crore.
So you are saying the lower the dilution, the multiplier increases 2 times in this example, if I understood.
Yes, sir. Definitely the value would be going higher because the investment amount is not changing. No, investment amount is still 45 lakh.
Okay, I understood.
So,
okay.
Yeah. So sir, let me be very honest. Like, this is not a technical way to sort the valuation stuff or thing. I definitely do respect the DCF valuation and all those things happening. But for an early stage founder to pitch your idea to an investor, I think like this can be used as a good tool to kind of understand what is the valuation that you should be pitching to the investor.
No, I perfectly fine. So I agree with this thing. The only thing, if it's a 10%, whatever is there in my mind, it was working out. But my only question is, will it be just justified that instead of either an investor don't want to invest more than 5% or the person founder is not going to dilute, but is just doubling the valuation based on what you suggested from instead of 4.5, it becoming 9. That is one my concern. Now, I want to put one more qualifier on this investment because I'm getting into a specific so that I understand the sensitivity in the formula what you are suggesting. Now, this 45 lakh investment, because I have spent some time with him yesterday. See, it is not an investment in plant and equipment. The majority, if I have to look at it, because of the nature of the business, it is in working capital. This 35 out of 45 lakh is what I understood from a very high level review is in working capital, not on capex. Will that change your answer?
See, sir, this is what I'm telling. This is not a technical valuation. What I'm telling.
Right.
This is just like for a person who is raising 45 lakh, I wouldn't recommend them to go to a registered valuer, get a valuation report for 1 lakh rupee, because 1 lakh is kind of more than 2% of 45 lakh what you're going to raise. And even if he's not able to raise the fund, this 1 lakh is gone. And no investor would rely on that 1 lakh report is what my personal experience is. So it's just kind of a thumb rule to approach the investor with a valuation. My answer won't change in that case also. So it's just a thumb rule. That's what I'm telling. It's not a technical.
No, I understood, and I also understood your rational and suggestion, a practical solution that not to go for valuation. I fully agree with you. My only concern in this is that if you invest 45 lakh in a plant and equipment or something, where the owner cannot take it and go immediately, but whereas this is a liquid asset. Tomorrow, if they liquidate inventory and receivable,
sir, you don't worry about that. The investor would be doing like kind of the proper due diligence and all those things they would be doing. See, it's going to be kind of a negotiation with the investor. So you pitch the idea to the investor, and the investor should be convinced about the idea first of all. And secondly, there will be definitely an agreement between the investor and the founder. So in that case, definitely there will be a lot of hooks that the investor would be keeping in, wherein the founder will not be able to kind of see. There will be definitely a salary kind of cap which the investor may propose. The founder can take only this much amount of salary, or when withdrawing, when the spend is more than 5 lakh rupees, the investor approval should be obtained. So there will be a lot of hooks that they will be keeping in the agreement, and they will be kind of trying to protect their interest also. So that is something what comes at a later point of time when we kind of have a term sheet, or when we have a shareholders agreement or anything, like when we have a definitive document there.
Perfect. I think, thank you so much. This is a very, very useful explanation. But so thank you so much. I'm happy to join this session. Maybe I'll connect with you offline later. Thank you.
Sure, sir. Sure. Thank you. Yeah. So, Garima, you were asking something, right? You can continue with your question. Garima, can you unmute and ask the question? Hello. Himanshu, you can. Yes.
Okay, so I want to ask, my question is a bit different. So I want to ask, like, I've just started a company. I'm not making any revenue, but I have built a product, right? It's a very good product. So the thing is, I think I need money, but
Okay.
what are the parameters I should look at to even go for funding?
See, I think that was explained in the first session. I would actually recommend you to see. I'm just definitely I'll be unmuting you next. So yeah, Himanshu. So the thing is that you can have a video recording of the session in our WhatsApp group. So I will actually ping all those. I mean, or pin all those recordings in the group. So there are a lot of prerequisites for before you go for a fundraising thing. First of all, I would recommend you to kind of go for a friends and family round and get some fund and kind of try to build your model and make sure that it is foolproof and ready to pitch to an investor. That is one thing I would recommend you to go. And definitely, your company should be kind of in a DD ready manner. When I say DD ready, it is due diligence ready. So the investor will be having a due diligence done by a CA firm or a consultancy firm whom they may actually appoint. So they are going to scrutinize your books. They are going to kind of look your compliance, like kind of books of accounts and everything. So yeah, so those are the things like I would recommend you to see the last, the first part of this webinar.
Okay, got it. Thank you.
Yeah, thank you. Yeah, Amjad, hi.
Yeah, hi, Abhijith. Yeah,
Hi.
it was a wonderful
Yeah,
session.
hi.
Actually, although I joined late, but I just want to we were speaking about the investment specific investment details. We were speaking about the valuation for in an investment perspective, right?
Yeah,
How exactly it would differ from an acquisition or merger perspective? Like, what all are the things we have to look forward to when we're looking for that?
So definitely, Amjad, the thing is that when you're looking for kind of an acquisition or merger, it's actually kind of entirely different board game. It doesn't have nothing to do with the startup valuation or anything. So maybe at that point of time, you should be having a technical valuation report because at the time of an acquisition of merger, you have a pretty stable cash flow. I mean, your company might have been doing good. Your cash flow is predictable. So in that case, maybe you can predict the cash flows for the future 5 years and you can do a discounted cash flow method. At that point of time, I would advise you to get a valuation report because you are also kind of making money, and in the acquisition thing also you are not going to sell your company at a very cheap price. So at that point of time, I won't mind you spending a bit more money for technical valuation. Get a good valuation report from a good valuer, and that should be kind of a way to approach with the acquirer, your prospective acquirer. And in some cases, maybe at that point of time, the investor or the person who is going to acquire your company may actually come and tell that this person should be valuing your company. You should get a valuation report from Big Four. Those things can also happen depending on the size of the deal and everything. Is it clear?
Okay, so yeah, that's clear. I just have some follow-up questions. Like, can I take it offline? Like, I have your number in the WhatsApp group.
Yeah, sure.
Okay.
Definitely.
Yeah,
We'll speak.
yeah.
No worries.
Okay.
Yeah.
Thank you.
Yeah. Thank you, Amjad. Yeah. Is there anybody else have any question? I think Garima Gupta actually posted a couple of questions, but she is not there right now. So I don't think like I should take the question now. Anybody else have any question? Or can we wind up the session? Okay, so the group link is actually put in the chat. You can actually join the group wherein we actually post the video recordings and we actually give update about our next session. So, so everyone, thank you for joining this session. Like India is playing against England now at 8 o'clock, and it's World Cup final. So I also don't want to kind of extend the session today. That is all. Actually, hope that India will win and lift the World Cup today after 17 years. Like in 2007, India got the last T20 World Cup. So yeah, that's it for today. So thank you everyone. Thank you for joining. Thank you for participating. Thank you for asking questions. Mostly the next session would be on how to create a business plan. It is going to be a bit technical thing, but I'll try to kind of explain it in an easier manner. Please do join the WhatsApp group so that you get updates about this session. Thank you everyone. Thank you so much. Wishing you all a happy weekend. Thank you. Bye.